and this is Shane Spells again with RTAD Financial. A close corporate friend of mine asked me to talk about employee stock option plans. So get your pens and pencil ready. Hopefully I can improve your financial acumen when it comes to employee stock option plans. So an employee stock option plan gives the employee the right to purchase company stock for a specified price for a specified period of time. Now, the employee is under no obligation to exercise the option. Now, to exercise the option just means that it gives the employee the time to purchase the shares for the specified price. Now, stock options are usually used for deferred compensation and usually have a vesting schedule. There are generally two types of stock options: the incentive stock option and the non-qualified stock option, and I'll discuss both. Now, you have to get familiar with these terms. There's the grant date, and at the grant date, which is the issuance date of the stock option by the employer, it usually isn't a taxable event for the employee if the fair market value of the stock and the exercise price are the same. And should that employee decide to exercise the option, there is an exercise date. And usually at the exercise date, when they decide to purchase it, it isn't a taxable event either. Now, the third date, which is important, is when they decide to sell the option. There are usually tax consequences, and that is all dependent upon the holding period. There are holding period requirements. If an employee holds the option for at least 2 years after the grant date and at least 1 year after the exercise date, they are usually able to pay long-term capital gains tax, which is usually less or lesser than their ordinary income tax bracket. Now, that is the significant difference between the incentive stock option and the non-qualified stock option. In the non-qualified stock option, you still have the right to purchase shares at a particular price, but at the grant date, there isn't usually a taxable event if there isn't an ascertainable value at grant. Now, at exercise date, there is a difference. At the exercise date, what the employee has to do is they take the option and the price per share at the exercise price they give that to the employer. The employer then records a W-2 income based on the difference between the exercise price and the fair market value of the stock at that time. That distance is called the bargain element. Now, they will be charged, like I said, recorded as income on their W-2, but what they pay would be their cost basis in the stock. And if they decide to hold that stock longer, there will be a capital gains tax when they sell it, depending on whether or not it's a short-term capital gain and they held that stock less than 1 year after they exercised it, or they will pay long-term capital gains if they held it more than a year after they exercised it on a non-qualified. So there you have it, the incentive stock option plan and the non-qualified stock option plan in a nutshell. I hope you liked the video. If you do, please like the video and put a comment in there and tell me what you'd like me to talk about. Go to shanespellswealth.com. That'll drive you to my YouTube channel, and subscribe. There's a lot of information there that could be formidable for you to learn a little bit about investing in your portfolio.